All right, so we've been doing a lot of show and tells on single stocks. Today, I'm going to do macro. Before I get into that, just want to say this channel, not investment advice, opinion, engagement, entertainment, information, whatever you want to call it. It's that and only that. Win, lose, gains, loss on you. All right. Also, if you're looking for stock picks beyond what's on this channel, well, check out my Substack link below. Also, check out atgdigital.media. This is our company where we sell subscriptions, and we've got multiple tiers starting at $9.99. So check us out, see what's right for you. All right. So what is going on right now that is super important that no one is talking about? Well, of course, I have a show and tell. I mean, did you think I was going to come empty? Hey, come on. Well, there's something big going on right now. It's big, and it's going to take on bigger and bigger importance as 2022 closes off, 2023 begins. And I believe it's responsible for the slightly better sort of tone, if you will, in growth stocks, in our stocks. Those of you who don't know me, us, I focus on what I call OGI, opportunity, growth, and innovation. So we're talking about stocks like Teladoc and Coinbase and Zoom and others that have been, of course, completely destroyed in 2022. But if what I'm seeing, this big thing that is unfolding right now, is right, we're going to see a dramatic, stunning, and shocking turnaround. And I am going to explain in this video why I believe that is going to unfold in 2022 and far beyond. So the thing that's going on, thrown for dramatic effect, by the way, well, it's not in the stock market. It's actually going on in the bond market. Bonds, for those of you who don't know, are essentially loans. So, for example, there are lots of investors, especially big money investors, that lend money to the US government, that lend money to big companies. Those are called bonds, and they trade in a market just like the stock market. It's a very, very large market. It's in the trillions and trillions of dollars. The government bond market, in other words, the government borrowing money by itself, is worth tens of trillions of dollars. So this is a big deal. What goes on here matters and really affects prices of everything from stocks to crypto to real estate, everything. All right. But for the purposes of this video, I'm sticking to the stock market as it reflects on our stocks, opportunity, growth, and innovation stocks. All right. So you'll see this headline, which is that the yield inversion is now at this very extreme record level. All right. And what are they talking about? What is this yield curve inversion that's referred to in the headline that just popped up earlier? And what does it mean? So I'll deal with that. And why does it matter for us? I mean, what's the point of watching this video unless like, hey, unless there's some real money world impact on you? All right, so first let's deal with question number one, which is what is this yield curve inversion? All right. So I have to sort of preface this by saying normally in normal markets, when you lend money for a longer period of time, you would expect to get a higher return than if you lend it out for a shorter period of time, right? So for example, if you are lending money to somebody for 10 years, you may ask for 10% a year. And if it's just for 1 year, you would be like, well, it's just 1 year. I'll ask for 7%. That's a normal market, and usually the way that bond markets are set up. Longer term interest rates for bonds, loans, are generally higher than for shorter term. But right now, this is inverted. In other words, it's upside down. And that's this yield curve inversion. And it's a reference to government bonds. In other words, US Treasury bonds issued by the US government, which are considered to be the safest bonds around the world because the US government is seen as being, generally speaking, beyond default. And the idea here is that the government controls the Federal Reserve, which controls the issuance of dollars, so they could theoretically print as much as they want. Now, it's not completely true. Congress can be involved. They could say, no, you can't do it, etc. But that's generally the way the world treats it, that US bonds, Treasury bonds issued by the government by the government of the United States has no credit risk. In other words, they're going to pay you back. So that's the market in which this yield curve inversion, this big thing that's going on, is happening. And where if you go right now, if you go and buy a bond issued by the US government, they'll give you 4.76%. In other words, you want to lend your money to the US government, they'll give you 4.76%, which is pretty good, right? 1 year, 4.76%, especially relative to what it's been for the last 10 years. Yeah, lots of people want that. But it's kind of weird, right? When you look, the 10-year bond, if you want to lend the government money for 10 years, they're like, no, only 3.69%. And okay, to be truthful, it's not the government that sets that rate. It's the bond market. It is bond market investors who are buying and selling bonds on a regular basis. They are setting this rate by being willing to give you 4.76% because they come and through an auction process help the government set this rate. So this is an inverted yield curve because normally this should be the 10-year bond yield should be higher than the 1-year bond yield. And there's completely normal reasoning for this, which is that normally inflation rises over time. Everyone knows this, and especially in the last couple of years, everyone understands today what inflation is. In other words, your money is worth less and less over time. And over 10 years, most people can see that prices have risen in dollar terms for the vast, vast majority of things. So that's what inflation is, and most people would agree. Inflation, it rises over time, the government prints out more money, and prices from everything from eggs to, most things, they keep going up. There are definitely things where things go down, but for the most part, inflation rises over time. The other reason why you would get paid more the longer your bond is for, or the longer you lend your money out for, is that, well, more time means more risk and greater. You're taking on more uncertainty. So of course you expect to be paid for that. Financial markets exist to price that. So if you're going to lend the government money for 10 years, well, it's 10 years where you can't get your money back at the same rate where you gave it to them. So of course you expect to be paid for that. So it's normal that the 10-year bond interest rate should be higher to pay you for that uncertainty, or pay you for that risk. And then, hey, there is this small chance that the US government, despite everything I say, that it could default. I don't know, maybe there's a particular circumstance where Congress and the president don't agree and we somehow default or something like that. And there is that risk as well. The credit condition of the US government changes because people prefer the bonds maybe of some other country, or something happens and you want to be paid for that risk. So it is really, really weird that the 10-year bond is now trading at this huge difference. If you go back to that slide, you'll see that it's over 1%. The 10-year bond is at 3.69%. The 1-year bond is at 4.76%. This is a very large spread, which is why that headline from the Wall Street Journal said, but this is an extreme inversion. It's very extreme. Like, you can not really find this in recent history. It did not exist in the early 2000s or the 1990s or the 1980s or even truthfully the 1970s. And I went back and checked. I have not found a 1% difference between the 1-year rate and the 10-year rate as far as I could tell. So let's go back to question number 2, having dealt with what an inversion is. An inversion means that the 1-year bond is paying a much higher rate than the 10-year bond. And this is at an extreme point relative to human history. All right. What does it mean? Well, in my judgment, in my opinion, what it's saying is that inflation is set to decline. Because remember, point number 1 about being paid a higher rate for the 10-year bond versus the 1-year is that inflation rises over time. So it seems very reasonable to me that the bond market, which in my experience is generally a smarter market, they're more strategic in their thinking, they're more long-term in their thinking, they're telling you that inflation is set to go down and to keep going down. And that's reflected by the size of that inversion. There have been periods of time where bond prices have been inverted by 1%. I can't find it in recent history. So that's a very, very large difference. And there's a strong signal, a big signal saying the bond market believes with really huge conviction that we're going to see deflation, and it's likely going to be of a significant magnitude and for a long period of time. And that is represented in that 1% spread between the 1-year and 10-year bond. The other thing that I believe that it's indicating is conviction, high confidence that this is going to happen. In other words, the period of inflation that we have seen from 2021 and 2022 is going to be dramatically reversed in high magnitude, and it's going to be sustained. In other words, the prices of assets will need to go from where there were concerned about inflation and it continuing, all the normal assumptions about inflation, you have to actually just completely flip them over. And now you have to actually start to think like, you could see a period of time, and I put down the time frame of 10 years, where prices could keep going down and continue to keep going down and continue to keep going down. Not just have less inflation, but you actually have lower and lower prices. That would be a complete and utter game changer. It would completely invert, completely make upside down all of the assumptions that people make. In all assets, people assume that prices are going to go up. So if you're going to have a period of lower prices, that would completely change how you would value, for example, companies that have no growth or have really been stagnant for a very long period of time. Because a period like that means that you're going to see slow growth and in all likelihood, something like recession-like conditions, because many companies are going to struggle if we are going to see a period of lower and lower prices. That makes sense, right? Because, hey, most companies depend on inflation to lift prices. That represents part of their profit. So we're going to see lower prices. We're going to see lower growth. And some companies are going to go bust, especially if they've borrowed a lot of money. They are not going to be able to make their debt payments. So that would drive, again, recession, because it would create an environment where companies would struggle. So in that environment, what would you want to own? What would you want to own? In other words, a period when prices are going down for a sustainable period of time, and they're going to drop prices down quite a bit, and where you've got slow growth. Slow growth is going to be the norm for a long period of time. Well, in that environment, the most scarce thing is going to be growth. Growth. You're going to want to find something that can grow. In other words, stocks that have the ability to either retain their pricing and where their growth will continue. In other words, there's something that they're doing that's new, that's different. And there is an entire group of stocks. It's our stocks. It's the opportunity, growth, and innovation sector. Think about all of the new technologies that we are invested in, the Internet of Things, artificial intelligence, blockchain, 3D printing, precision medicine, new energy. These companies do not depend on aggregate or general economic growth for their growth. Their growth is driven by taking market share. They go and take market share from incumbents. Incumbents mean that the companies that dominate those business sectors and industries today. And they do it by employing innovation, which drives their growth, which creates the opportunity. So it's the innovation that matters. And while many people can say, well, Paul, why can't the big companies just go and implement innovation? Hey, the best example for this is Tesla. Tesla is a pure EV and autonomy company. That part of the company. They do have an energy business, but even that is a completely new energy business. Now, if you just compare the car automobile side of the business, Tesla does not have old plants that they have to write down, internal combustion engine plants they have to write down. They don't have pensions that they have to pay based on those plants and making internal combustion engines. All of Tesla is just based on the new. Their entire growth profile is based on electric vehicles. And then the implementation of software and autonomy. It's a completely different ball game than what Ford and GM, which they're carrying all their legacy assets, which have to be written down over the next 5-10 years to zero. Then they have to spend all this money to lift their organizations and spend billions of dollars, like Ford estimates it's going to cost, I forget the number, it's in the $5 to $7 billion over the next 5 years to really scale up very rapidly to compete with Tesla for EVs. So the innovation companies that don't have these legacy assets, well, they have growth because they're just going to take market share from the incumbents and the old companies. So they're going to have growth. They're also going to not be suffering from lower prices because people are going to be demanding their products. So their prices at worst will stay stable. And potentially they can get a benefit to the extent that their products provide greater efficiency, greater utility. Just think the right example for this is sort of like the iPhone. The iPhone was significantly more expensive than the previous smartphones, and yet really no one really thinks about whether it's worth it or not because the utility is so much greater than what existed before. And only innovation can deliver that kind of increase in utility. So that's one factor why growth stocks. Now, from a financial perspective, many people sold our innovation stocks down last year because they said, well, in an inflationary scenario, because many innovation companies, their profits are going to come a little bit later. It takes capital and resources and time for those profits to show up. And they might show up in year 5 or year 6. And if there is going to be inflation, then obviously that money is worth less by year 7. But if there's going to be deflation, the value of that money is actually going to be worth more. And the markets, well, they will start to price that in. They will start to price that in. And so if what is going on in the bond market is right, we are going to start to see a major turn in the prices of our stocks as people start to look at those cash flows going out 3, 5, 7 years and say, they're going to be worth more and more. And to the extent that the bond market is telling you with high certainty because of that spread, almost 1.1%, that they have very high confidence in this deflation. Well, then that confidence is going to be reflected in asset prices. Finally, if we're going to be in a period of slow growth and sort of like near recession on a regular basis, Well, growth companies are going to be scarce, which makes them, of course, more valuable. Scarcity drives value. And that is going to drive massive demand because after the last couple of years, people have pretty much sold out of these opportunity growth and innovation stocks and assets. And they're going to come rushing back in. And as they come in, of course, who benefits? Well, it's the folks that own it. It's the folks that own it because as demand comes in, they're forced to bid prices higher. Those are gains in your portfolio. So it's been an incredibly painful year and a half, but big rewards are coming. And this period of pain will have been well worth it. In hindsight, people are going to say, wow, that was so obvious. It was so clear. You could see it by the technologies that were in place that were driving the deflation. But hey, you'd have to start with the bond markets to see this turn that is coming. So there's something big going on right now. It's starting with the bond markets. It's going to come into our stocks. We're going to see our stocks bottom out. And then as people figure out that this deflation, this big deflation is coming, they're going to come into our stocks and drive them higher. I am, as I like to say, my specialized hashtag, bullish, optimistic, positive, BOP on our stocks. It's now just a matter of time before it turns and turns dramatically and turns all these incredible losses into gains. Seems hard to believe right now, but stay strong hands, be bullish, be optimistic, be positive, and come back next week for another video. You know what to do if you like the video. Give us a thumbs up, subscribe to the channel, check out my Substack at atgdigital.media. This is Paul saying bye.